Hey, Tammy. So it looks like it's one. Do we have everybody? I don't see Councilmember Bergan, unless I just don't see her on the screen.
I don't see her yet either.
Okay, well, I'll give her just.
Oh, she just showed up.
There she goes. See, always waiting on her.
About that.
Okay, I just said we're always waiting on you.
I
Uh,
know.
since she has nothing else going on. Okay, so it's 1 o'clock. Call the meeting to order. First up is the approval of the minutes. Do my colleagues have any changes or additions to the minutes? Okay, seeing none. Next up on the consent item, any interest in reviewing the August sales tax chart? If not, we'll go into general business, and the first item is item 4A, the city employee and benefit program.
Hey, good afternoon, council members. Hopefully you can hear me okay.
Yes, sir.
Okay, I'm going to go ahead and bring up the presentation and walk you through where we're at with our 2024 benefits. Let me quickly get set up here. And I don't mind presenting the whole thing and then waiting for questions at the end, but if you want, feel free to just ask questions along the way if that's better. So however you prefer. But in reviewing our benefits for 2024, we're in a pretty good position. We'll go through what the renewal looked like, and then we'll spend a bit more time on our medical than anything else, just because our medical is the most costly benefit that we offer. And then we'll just quickly walk through the other benefits. So as you can see here on this slide on the bottom right is a list of all of our benefits that we offer. Actually, it's not all of them, but all of our major ones. We have our core benefits, our city paid benefits, and then some of our voluntary benefits. And on an annual basis, we go through a renewal of every single coverage item that we have. And we did complete that process, and we do have our final 2024 benefit package. Here's a quick look at the summary of our benefits. The ones that are in bold and in red are the ones that we actually had to actively renew, have some negotiations, and really make some decisions on. So you can see with our medical benefit, we'll go through that in a couple slides of where we're at. We had to do our dental and renew that this year, our short-term disability, and then our legal services. All the other benefits are ones that carried over as is and without any type of increases. So we'll focus on the medical, and this is the one that I'll go into a bit more detail than any other slide on. So our initial renewal that came in from Kaiser Permanente, our sole medical provider, was 17.4%. Very high. We haven't had more than a 5% increase from Kaiser since I've been here, and even in the years prior to that. However, with Kaiser's investment with the city of Aurora, they were able to sharpen the pencils before even officially coming to us. And that renewal, they were able to drop down to 11.7%, which is still really high.
Right. Can I ask a question right there?
Yep.
Dustin, is that okay?
Yeah, go ahead.
Ryan, are we getting any closer to allowing an option and allowing UC Health to be in the city also with Kaiser? I know it was like the Cherry Creek School District or the Aurora Public School District that's now doing that and offering an option to Kaiser. I know we had this meeting and it was ongoing conversations.
Yep.
Where are we at on getting a bid from UC Health?
Yeah, I do have a couple bullet points on that. In short, we do plan to be pretty aggressive with going to market, and I'll tell you a little bit why the why behind not doing it this year. That would have been my preference. That was our goal. We wanted to, but there's a lot of reasons you'll see through some of these numbers that we just couldn't do it this year. But the goal is to be pretty aggressive next year.
Okay, thank you.
So our broker, Aon, who is our consultant, they actually run their own numbers. So they do checks on all of our renewals. And their checks, when they looked at our claims and all the data, they calculated that our renewal should be about 14%, which is a good check and balance. It's bad because it means, yeah, there's a lot of increased costs, so it's a high renewal, But that 11.7 that Kaiser came in with was a pretty fair number. Still too high for us, right? But the reasons for these high renewals has a lot to do with inflationary costs and for just higher utilization in claims. So we had a bad year with utilization in claims, and then like we're seeing ever since post-pandemic, we're paying more for everything. And that also includes paying more for, wages for nurses and for doctors, and then medical exams and facilities. So we're now seeing those increases hit not only us, but it's hitting almost all employers. One quick technical piece of it, we have something called the loss ratio. It's how much the city or how much Kaiser pays in claims versus how much we are paying Kaiser for their services. And if that number is 85% or above, that's a bad number. What we've seen right now is Kaiser is losing money on us, as well would any medical provider, because our loss ratio in 2022 was 90%, and right now through June, it's at 91%. So right now, medical provider is losing money by insuring us. Hence, you see this increase. Through some plan design changes and
Ryan, real quick, I think that Councilmember Bergan, I almost called you Mayor Pro Tem, has a quick question.
Yes, sorry about that, Ryan. You said obviously inflationary costs, but then increased usage, why our number is, that percentage is so high. Is that claims for very significant health issues like cancer and heart attack and so forth? Or is that just, people going to the doctor more often? Because if it's the latter, maybe we're encouraging people to go too often. I don't know.
Yeah. No, I mean, it's great getting into these types of details. It is a combination of both. We track, or we have them track, large claims, and those claims are going to be anything that's over $150,000. And we've seen an increase in those claims. And then we've also seen an increase of the cost of those large claims as well. So that was a big factor. We also track to see how many are going to eventually end, and we don't have to have those large claims anymore, or how many are ongoing. So it's high, it's that, and then we have seen a higher utilization of surgeries, both required surgeries, but also elective surgeries as well. We also saw a high use of emergency use, and that's one of those items where we have the broker and the medical provider drill down into details to say how many of those are unnecessary, meaning they could have gone to urgent care or they could have gone to a doctor's office. And so we're really trying to sharpen up on how people are utilizing it. And we think by doing an active enrollment and better education, people might get in the better plans to help support that.
So from an educational perspective, the city would try to encourage people to go to the urgent cares.
In the appropriate situation, yes, or call the nurse's line, do certain things to kind of get more information besides just running straight to the emergency room.
Okay, thank you.
We did make some small design changes or coverage changes, and it lowered our overall renewal to 10.2%. So that's our final number. It was a 10.2% increase. On our high deductible health plan, there were some statutory requirements to increase our deductibles, which also meant lower premiums. And then we did increase our maximum out of pocket for the HMO plan. There were some enhancements to the prescription RX coverage. So employees will see a better coverage level there. And then in order to maintain our, what we did is we wanted to maintain how much the employees are paying. So the employees aren't paying a bigger percentage. They're going to have to pay more, but not a bigger percentage. So if they were only paying 10% for their coverage, they're still only paying 10%. But any type of increases, they're going to be paying, that increase. And I'll show you a couple of charts with that. It is worth noting that out of our 5 plans here, the HDHP plan, employees pay 5%. The DHMO 750, they pay 8%. DHMO 200, 12%. HMO is 20%, and triple option 25%. I like to highlight that because that's a very rich benefit we offer employees, and we are trying to maintain that cost share, keep the percentage as low as possible for employees as long as we can. We do want to focus on better plan enrollment. So an example is if someone's on our HMO plan, they have a lower emergency care cost. So for them, it's easier for them to go to emergency room because they don't have to pay a lot. But if you're on the DHMO 200, 750, or HDHP plan, you might want to think twice because you have to pay a little bit more for it. So we think that some of that consumerism, that education might be very helpful. And then here's where I'll talk a little bit about our plans to go to market. So we were wanting to do it this year. I'll tell you personally, as someone who's responsible for the benefit administration, I think it would be great if we had a dual offering. It's been my objective since I've been here. We just need to find the right time to make sure we can do it not only first year, but have a long-term sustainability. Why it didn't work this year is the timing of the market, the inflationary costs and impacts, the high claims. Those factors meant that if we went to market, we wouldn't probably get good competitive bids, or they would have just been buying our business for this year, and we would have seen future increases. We were seeing very high claims in January, February, March. So when you go out to market, these companies are going to be looking at your most recent claims, and then they're going to probably have a much higher increase. We want to try to have things settle down. We're hoping all those elective surgeries and some of these other things we're getting out of the system past the post-pandemic, and we should be in a better position next year to do it. Even if our claims run a little bit high the rest of this year, we are still going to go to market. We're supposed to be doing it every 4 to 5 years. Next year will be year 4, so we think it's best for us to do it next year. The other big reason is we want to make sure we're strategically planning so we have the best success. So networking is important, right? Meeting with some of these medical providers ahead of time so they get to know us. They understand what we're looking for. One reason why we weren't able to do a dual carrier last RFP in 2020 is because the new, I think it was Cigna, was asking for like a 30% guarantee enrollment of our employees. It was like 30 or 40%, but then Kaiser was asking for a 70 or 80%. The numbers don't match up. So we need to go ahead of time to really establish the expectations, have those conversations with all the carriers, and I think we'll be in a better position for them to be competitive with getting exactly what we want.
Yeah. Hey, Ryan.
And a lot of that has to do with strategy.
Quick, I know Councilmember Jurinsky mentioned this at the onset of her question about it's actually Cherry Creek Schools. I know it's Cherry Creek Schools, and they do Kaiser and it's not UC. What is it? Why am I blanking on the name of the carrier now?
United
Healthcare.
United, yeah. And so obviously it works. I know Cherry Creek's probably a slightly bigger employer overall, but it would be interesting to know how that's gone, how that, maybe talk to some of their your counterpart there and see how it's worked in terms of, having that choice for employees if it's worked or not.
Yeah, it's a great point. It's what we've already done. And that was when we were making the decision whether to go to market or not. We started gathering information immediately. We talked to our broker. We talked to our Kaiser individuals, who both of them happen to represent Cherry Creek school districts.
Yeah.
So we already have a lot of information on what's working and what's not working. We've also reached out to Aurora Public School and their connection there because they recently went sliced as well. So we've done a lot of legwork already to set ourselves up for a successful market bid next year.
Great.
And we're going to continue to do more. I actually haven't spoke directly to the person over at those agencies, just more so the brokers and the medical providers. But we have more work to do on it, but a good start. So I wanted to kind of pause there. Councilmember Jurinsky, I know you kind of asked specifically about the reasons, and this is where we're at and our intention for next year. So any other questions on that? Okay. Like I said, that was the main slide to go over. This is really just to show you where our plans are. It's a lot of information, but you can see up here are 5 different plans here. Then we have what our current plan is and then what the proposed or what the actual plan is going to look like. In the gray area are the only design changes we're making, coverage. This is one that's we're required to increase the deductible on the HDHP plan. And then we are choosing to increase the HMO out-of-pocket expense from $2,000 to $3,000 for the individual and $4,500 to $6,000 on the family. We took a look at utilization. So we felt pretty comfortable in making this change. because only 4% of the 612 that were enrolled actually hit their out-of-pocket max. So it's not going to have that big of an impact to a lot of these individuals. But if they are concerned with this, we're going to really encourage them to explore some of these other plans. And we do think some of these other plans are actually better plans. They're richer plans in terms of coverage and cost. The one thing I do want to mention on this slide here is we had this item here called actuarial value. This is the value. This is the cost that the employer is paying for the overall cost of the benefit. The higher the number, the better you're at. So for perspective, if you look at the Colorado Medical Exchange, if you are at 60%, that's a bronze level. If you're at 70%, that's going to be a silver level. 80% is gold. 90% is platinum. So you can see almost all of our plans are offering a platinum level plan. I also want to mention this is because that's how we've negotiated, or we have our collective bargaining agreements with both FOP and Local 1290, is we have it written there where we offer at least one plan that's a 90% actuarial value or above, and you can see we have 4 of them, with our last one being close to 90%. So it's just more illustrative of again, the richness of our plans.
Councilmember Bergan.
Thank you. Can you go back to that chart? So triple option, what is that the one where you can go pretty much to any hospital or doctor?
Yes, it's outside of the Kaiser network, so you can go to other facilities. But we ideally would love to have another provider, like a Cigna, an Aetna, a UHC, to be able to offer that type of service.
Okay, but it's only 88%, but yet gives you more choice. And then the deductible seems pretty reasonable.
Yeah.
You're just paying higher premiums, right?
Correct. They're paying a lot more for that coverage.
So which one's the highest? 96, the HMO. That's the highest value for the city, not necessarily for the employee?
Correct. Exactly.
Oh, okay. Got it.
Exactly.
Okay.
Yep. And you'll see on this next slide, and this is a lot of information. I'll break it down with premium increases, but what we're really looking at here is let's look at the employee costs from 2023 to 2024. You can see on the triple option, they're paying for family coverage. The employee is paying $641 per month. So that's it's pricey. Whereas if they're on our HMO 200 plan, it's $255, or what our richest plan, if you look at crunch the numbers, is actually our HDHP plan, and they would only be paying $89 a month. So you could see that there's big differences in our plan. On this one, I'll highlight 2 things. One is the overall cost increase is that 10.2% is $4.3 million of an increase, because this is a huge line item. So from a city standpoint, we're going from paying $37 million to $40 million. So it's why we spend so much attention and focus on medical, because this is a big investment for the city.
Yeah.
And then you can see here, this is how much the employees are paying for each plan, from 5% to 25%. And then the last thing that I'll really highlight here is what's the cost impact for these increases. So the cost impact you could see is 7.6% if you're on the HDHP plan. So you can look at this column for each one of our plans. So they're seeing anywhere between a 7.6% increase all the way up to a 15% increase. And then dollar amount, you can see on a monthly basis, we're looking at ranges that employees are paying extra per month, $2.19, all the way up to, again, the triple option, you're seeing $61 a month. Most of our employees are going to be in the DHMO 200. So you could see here what the actual employees are going to be seeing as terms of an increase. But for perspective, although they're seeing like a $9 up to a $25 increase, what the city is actually seeing is the city is seeing increases of $62 up to $181. So if an employee is upset that they're paying an extra $9 a month, we'll kind of remind them that, well, the city's paying $62 extra for your coverage. So we're still paying 88%, while they're still going to be paying 12% of the cost. And with that, that's really the medical. Like I said, the remaining slides will go by really quick. So maybe I'll pause here to see if you have any additional questions on the medical.
Any additional questions? No? All right.
And then dental, we're in a good position, a 1.4% increase to costs and premiums. Our broker sees it as it's more of a 3% medical trend, so we're doing really well. We're not changing coverage, and we're not changing the cost share, how much percentage that the employee is paying. We are self-funded with this, so that means the city actually pays the claims, and then we pay dental to actually use their network and administer all the paperwork and the claims. We are seeing a slight increase for that, but it is a rate that's guaranteed through the end of 2025. You can see here just the cost increases comparison to medical. Instead of that 46 million, we're paying $2.7 million for dental, and a 1.4% increase. And then you can see the increases to employees is very minimal. What they're actually going to be seeing is 4 cents up to 24 cents per pay period in terms of an increase. So, and then our other benefits, you can see here we have rate guarantees for our other coverage levels. We partner with a lot of different vendors, VSP for vision, Voya does our long-term, short-term, as well as our life insurance. No changes to our accidental, critical illness, or hospital indemnity. We are introducing a new coverage level for legal services. So that's an enhancement that we're providing. And then, of course, we have these other benefits: identity theft, flexible spending accounts, a transportation or transit benefit, COBRA. We have our retirees, our employee assistance program, and then also not listed here, we have pet insurance, as well as home and auto discounts. And then last slide, our open enrollment. It's going to be from October 28th through November 19th, 3-week period. The effective date of coverage changes will be January 1st. We are making a decision to do an active enrollment. We're very cognizant of the impact to employees. Instead of having benefits roll over, they actually have to elect their benefits. We're doing it because this is our first year with Workday, so getting them used to it, I think, is really important. If we do introduce a new carrier or a full replacement carrier next year, we have to do an active enrollment, so they'll already be familiar with the system. We haven't done one in a few years. We also think this is a good opportunity for employees to evaluate their plans. So one way we can curb that projected cost that you saw there is if employees get enrolled in the right plan, the employees will save money, but then the city will also save money as well, because we're paying less if they're not enrolled in a higher plan that they don't need to be enrolled in. And then the enrollment is going to be through Workday. We're no longer using the old system, which was U2X. And it's going to be a very similar experience that our new hires are doing. So a lot of our employees should be used to that as well. There's a very friendly mobile option available. And then we'll have plenty of opportunity for communication. Sorry, Councilmember Bergan.
Sorry, no, I'm sorry. So I'm not enrolled in Workday. I don't know if any other council members are. I liked the old way. And I also liked that if I'm just staying the same, I didn't have to do anything. So now that I have to do something, am I going to have to go into Workday? Because we just literally do not have time to be doing a lot of this stuff.
Yeah, we'll provide details of how that process works, and then we can have an alternative for you guys as well. So where you
could call somebody.
Yep.
Is that still available?
Yes, but we are going to be doing that in-house because it's Workday, and that's the beauty of it. And with the old system, it was someone else's system, so we needed that type of support. Whereas now we can do support in-house because it's Workday.
Okay.
So you'll be able to call the benefits team.
But I'd have to be enrolled in Workday to even affect my benefits.
Yeah. So we'll send a separate communication to all council members on the process. All of our employees are enrolled and actively use Workday, but you guys are probably the only group that hasn't had login information. So we'll work with you guys as a one-off.
Thanks.
Other questions for Ryan? Okay. Do you have anything else, Ryan, or was that?
That's it. It's informational only. So thank you.
Yeah, great. Thank you. Okay, item 2B, and this is an analysis of the proposed moral obligation bond for the FIC.
Yes, good afternoon. This is a continuation of our discussion from our July meeting, where we discussed the moral obligation policy and also existing moral obligations of the city. So in that meeting, we discussed the proposed refinancing of Bioscience 3. The city has moral obligation support currently on the outstanding debt on that building, on that facility, and that is a loan with Commerce Bank. That moral obligation support rolls off at the end of 2024, and the loan itself comes due in July of 2025. So there's a little bit of a gap there. But the financial advisor to the Fitzsimmons Redevelopment Authority, or FRA, has proposed a refinancing of the Bioscience 3 loan with a new money component. In other words, they would refund the outstanding loan and also borrow additional funds to be used for capital projects within the bioscience buildings. Continued moral obligation support was assumed in their analysis and their proposal. The support would take the form of a debt service reserve of approximately 3.2 million that would be drawn upon in the event there were insufficient revenues to pay debt service. You may recall from our previous discussion that the city has no ownership in the Bioscience 3 building, nor does it receive revenues from that facility. At the end of the meeting in July, Council members Zvonek, Chairman Zvonek, directed staff to analyze the proposal and return to M&F with a recommendation as to whether or not the city should continue to provide moral support on the proposed new financing. So we enlisted the city's financial advisor and the city's bond counsel to further to delve into, do a little deeper dive into their proposal. We considered 3 different scenarios. One was that we provide moral support, moral obligation support for the refunding plus new money. The next one was a moral obligation support just for the refunding of the current loan. And the third scenario we looked at was not providing moral obligation support. So the moral obligation support with new money, the assumed or forecasted revenues made it very tight for debt service coverage. That means they wouldn't have, they had 1.25 times debt service coverage, which means that after all their bills were paid, they have a buffer of 25%. That was the riskiest proposal to the city. There's a higher likelihood of a reserve drawdown in that scenario. The next one we looked at is providing moral obligation support just for the refund of the outstanding loan. That had the advantage of having a stronger debt service coverage of 1.6 to 1.9%. So it reduced the risk to the city versus the new money scenario. And the third one we looked at was no city moral obligation support. The revenues related to this project are a little bit unstable, mostly due to the tenant mix. They're looking at startup kind of bioscience companies, which tend to be in and out of the business a little bit more than established companies are. And without moral obligation support or some other kind of credit support, it's unlikely that they can market those bonds. We've attached a summary of the analysis to your in the packet. So if you have any questions about that, I'm happy to answer them. So after we did the analysis, we discussed with the acting city manager, the DCM's legal counsel, our financial advisor, and Chairman Zvonek. It was recommended that the city have a discussion with the FRA in other words, go back to the FRA and ask them to look for alternative credit support structures. And that we would be recommending to this committee that we would take no action on this at this particular point in time. So we did have that conversation a couple of weeks ago with FRA, and as of today, we've not heard back from them on any alternative credit support structures. We will keep you advised. if they continue to pursue city moral obligation support. Again, our moral obligation support goes through the end of 2024. So we have some time on our side. I think they're feeling like they need to get this negotiated and done now, but we still have moral support for another year and some change. So I will again come back to you if I hear anything else. And if the committee wants me to move this further, I'm happy to entertain a suggestion.
Yeah, and just quickly, just for information, 'cause I think it might inform your question, Councilmember Bergan, or maybe not. But another scenario we have talked about, because we do have time, is that there are infrastructure needs that are a part of our stack, I believe, including Montview and other things that the city currently is looking for ways to fund. So one of the other options, a fourth option, if you would be if we went forward with this and extended not only the refinancing of Bioscience 3, but that new money, that those new monies could go towards a city priority on the campus from an infrastructure standpoint. And then also there would probably need to be some way for us to have a lien or some sort against the building to protect, our financial interests. But as it was mentioned that by Teresa that we have some time, and I think it's probably best. I know we have an executive meeting as you both know, I'm on the FIC board. This, in fact, it's tomorrow. I'm sure this will be brought up as a topic of conversation, but I think that the recommendation, at least for now, and I agree with it, is to pause. We know that there is a risk to the city. I do believe investing in that campus is important, but I also want to make sure that we're not leaving the city and therefore taxpayers on the hook for not being able to recoup their dollars.
And just to clarify, we do have the ability to lien the facility and would continue to have that ability if we went forward. In fact, we could strengthen our profile as far as right now. If they draw on the reserve, we can establish lien on the facility. If we were to renegotiate continued moral support, we could make that a bit stronger so that we would have an interest in the building.
Yeah.
At the onset. So,
Councilmember Bergan, did you have a question?
Yeah. So, University of Colorado, our UC campus, are they able to give them the moral obligation versus the city?
I think that's a question for their bond counsel, but we have asked them to go back to other parties to seek moral obligation support as well. There's also other structures that they could pursue to enhance the revenue stream and make the bonds more marketable as well. So they're going to do some due diligence. I don't know what they're going to come up with, but we'll let you know.
I don't know if they've actually approached the University of Colorado or the UC Health.
We haven't had any further conversations at this.
I don't think so. I think they know, obviously, because they're Don Elliman sits on the board. So does Todd Solomon. So they are aware of the fact that they're asking the city for the moral obligation, and I believe that the university probably could. And in fact, they're a tenant of Bioscience 3.
Right.
Interestingly enough, but I do think, as I said earlier, one of the opportunities we might have, and this is where I don't think Laura is on this call, which is fine. Her and I have been having this conversation, and I've talked to her some more. But if there are transportation needs that are a part of our infrastructure stack that we could take off of our plate with this, I think that would make a stronger case for doing it, again, with the caveat that there would need to be the lien against the building so that we would have something that you could recover, because you can't do that with a road. But that might make the case for it. But I think in the short term, it's just not immediately jumping forward with this, despite the fact they might want to, in part because we do have time. The urgency isn't as great as I think that it was made out to be, given that our current moral obligation is extended through 2024.
So what about their other buildings? Don't they have equity in those buildings, and they can't take out a loan against their other buildings that
I'm not aware of the structures of their other financings, so one of the things that we did suggest to them they look at is maybe combining all the bioscience buildings and their revenues and doing a package, so there'd be a more stable revenue stream, but again, I'm not familiar with how those other buildings are financed.
And Dustin, you don't know if they.
Yeah, I'm not positive. I know one of the other benefits of having the moral obligation bond is that with the cities backing it, it does positively impact the interest rates.
It increases investor confidence.
Right, but I mean, if they had assets to pledge, just like the city does when we do our certificates of participation, I mean, an asset is important that a bank could seize their asset. So I guess I was just, they've got other buildings and I don't know what if they're just, they still owe on all of them or.
You know, we could probably provide you more details on what they have and what the balances are. But I would like to just add that, you know, they've found ways to finance other facilities. And I think that's the important part of this is that they have found ways to do that. And the real point that we left them with was how might they go about finding a way to do this independent of the city, because it is a project that's been out of the ground, and we usually, you know, don't provide moral obligations ongoing for projects. They should be self-sustaining.
Mhm.
And I think that's one of the things that we should highlight here is that, you know, this one has been paying its way. And even though we were part of the original financing for Bioscience 3, they really did the whole transaction independent of the city with the bank that they are with. So, you know, they were just, I think, looking for a lower interest rate. Yes, that could benefit the campus. But at the same time, I think that in the end, just like the other bioscience projects, this one should be self-sustaining, and we should ask them to do their due diligence, and that's what we've done, so that they can figure out a way to make it self-sustaining in the end.
Thank you.
One other thing, if I can add, is that if this proposal was coming to us, it's a brand new proposal, it would not meet the requirements of our moral obligation policy. We do give it some consideration because we have an existing moral obligation on it, but if it was a brand new proposal, it wouldn't meet the criteria.
Any questions for Teresa on this? And then this was for information only, right, Teresa, at this point?
Exactly, exactly.
And I will be, and if there's anything to report back after the upcoming board meetings of the FIC, I will report back to you all.
Perfect. Thank you very much.
Yep. Okay, we'll move on to item 5. It looks like, and I don't know if we can do them all together, but I hope we can, A through F. Looks like, is this Hans? Is this you?
Yeah, I can take this one. Yeah, I'm Andrew Jameson, also in the debt investments division. Before you, there are, it's a total of 6 budget ordinances for the general improvement districts located in the city. Relatively procedural thing where each year we have to approve the budget to collect a property tax that these districts have voted on, basically to tax themselves to fund various improvements within. It's usually like neighborhoods, for example. You know, the first one is Cherry Creek Racket Club, and they financed a masonry fence for the kind of the perimeter of the neighborhood. And so this is the measure to authorize those budgets to fund the property tax, which pays off the debt on these.
Are there any questions, my colleagues?
Then when do we vote on it exactly? At the council meeting or at the budget workshop? I think we do it usually at the end of the workshop.
Yeah, at the budget workshop, there'll be, you know, an opportunity for questions from the full council, and then this will continue down the path as the regular budget would, going to a regular city council meeting for first and second reading.
That's correct. We treat the workshop as the study session.
Right. Mm-hmm.
Yeah. Any questions on any of these items? And if not, is there any objection to moving them to the workshop this weekend? Okay, that's the direction. All right, final item, miscellaneous matters for consideration. Anything from my colleagues? And then if not, Tammy, I know that there was, oh, go ahead, Councilmember Bergan.
I think I keep asking this and I don't know if I'm just not listening correctly. The audit on the nonprofit. Who does that? Because wasn't it an outside was going to have to do the financial audit?
Let's see, Michelle, are you familiar with this?
Yeah, I think from the last meeting, I think finance was the one working on that, and they were partnering, I think, with the external auditors on that. So I believe finance was working on that. So I can work with Terry. Maybe we can get an update to you.
Okay, I think I asked about this a year ago, so it's taken a while.
We'll just, yeah, if we can have that on the October 24th agenda, just as an update, that would be appreciated.
Absolutely.
Okay. And speaking of the next meeting, October 24th, I know there was, Councilmember Jurinsky had pointed out an error, but Tammy helped correct it. So October 24th, same time, same place. Any conflict with either of you? If not,
I think so.
then that is it. Meeting is adjourned. Thanks, everybody.
Thank you.
Thank you.